This is Brian Lewis with the MMT Investing. I'm coming to you from Colombia this week. I'm going to take a look at the NASDAQ because we have a channel that no one's pointing out that I just realized like yesterday. Um, the trend lines that people have been drawing are not consolidation areas. This is, but if you take a look at this is a bottom on the NASDAQ. If we go to S&P, the S&P was rallying way ahead. And this was a top on the S&P, but if you go back to the NASDAQ, that was here, and it wasn't topped yet. But now you can see the S&P and the NASDAQ are both running into the top of the channel at the same time now. And so we're just in this channel. If you go to the NASDAQ versus the S&P, we have like a 15-year bubble trend of the NASDAQ having huge dominance over the S&P, and you can see it broke here. Last year, the NASDAQ dominance came way down. But this year it's rallied back up, but we're at support, or not support, we're at resistance now. We're back checking this bubble trend, we're back checking the neckline. And so this is a huge resistance area, popping this NASDAQ dominance trend that's been going for a long time. If you go to a couple other charts, not just NASDAQ, like big tech and risk on, I mean Bitcoin, if you look at Bitcoin here, the same sort of thing. We got a double top neckline. We're running up. We're back checking, like right under the neckline here. If you go to something like Tesla, the super meme stock, similar. We have a triple top break, right? Back check right here at the neckline. Tesla's doing the same thing. Bitcoin and Tesla are two of the biggest kind of tech and risk on kind of bubbly things that are doing the same kind of a trend. Yeah, so anyway, that's where the market is right now. It's in a down channel. It's testing resistance across all of the main charts, just in terms of trading. And then if you look at the EuroDollar futures, this is I flipped the chart upside down just so that it matches the interest rates. But we're up here around 5% interest rates. And what we had with the bank collapses like a week and a half ago was this magical thing where interest rates tried to go up and they failed and banks started collapsing. So this is probably the top of the interest rate cycle. And now we're pushing a little bit higher. So it'll be interesting what happens to this in the next couple of days. But you can see the consolidation here. It looks like a bear flag. And if we do get a down move here, that's going to be a crash in the market. That's going to be a huge down move. And it's gonna, I mean, that's gonna drop interest rates significantly, where the Fed might have to come out and cut, I mean, do like an emergency rate cut of 1 or 2% or something like that. Like it could be a pretty big rate cut that they have to do if this happens. And if we start the down move, that's going to be the backside of the cycle. So the up, just in general on the interest rate cycle, going sideways is good. At the bottoms, it's bullish. At the tops, it's usually bullish to go sideways at the tops as well, but it's more volatile at the tops. And the hiking cycle is not, it's usually neutral-ish. Like, it's not usually bearish, but this time we got 3 huge rips to the upside, gapping rips to the upside. This is a really steep and fast hiking cycle that was strong enough to pull the market down on the up cycle. The market usually doesn't crash until the down cycle. So we're getting close to the down cycle now, and when we come down, just get ready for it. But it's possible that this runs to higher inflation. But to me, just looking at like the M2 money supply is coming down, the bank loans are contracting. It's just the basic turnover of the economy, and obviously not just bank loans are collapsing, like banks are collapsing totally. So this is an easy call for me to say we're at the top of the cycle here. But we did get enough, I mean, we got enough of an upcycle to break our 50-year downtrend in interest rates. So if we do come down, I don't know how low we'll come. I mean, we might land at higher interest rates, 2%, 1%. We might go back to 0. I don't know. I don't know the downside target on this cycle if it's starting now. just because we came up and broke out of this thing. Yeah, so that's kind of where we are. And if you look at the VIX as well, the VIX is looking boring right now, but that's not that's not a safe thing. So if you go back, this is the beginning of our VIX uptrend. This is the Volmageddon crash, right? This is the 2018 crash. VIX comes back to support. COVID crash comes back to support. This is our weak bear market that we've had now on the upcycle. Now VIX is back at support here. So if the VIX were to break down this way and actually break this trend, that would be long-term bullish looking. But I would say most likely we're starting the interest rate down cycle and the VIX pops, and that's going to be a crash signal. When the VIX pops, when the interest rate cycle drops, yeah, people are saying Fed pivot. Like that's some kind of a good thing for the market. Like a Fed pivot to dropping rates means that they're chasing the cycle down. Like this is the COVID crash. Down moves are not good. Down moves are super dangerous. If you go back to the financial crisis, like this is the Lehman Brothers, and this is actually pretty similar. It's a peak and a bear flag. Boom, financial crash. And the second half of it, this is down moves are the crash. Down moves are where it crashes, and this is the dot-com bubble, which is more gradual. But boom, the whole down move, that's the entire dot-com recession and bear market. The down moves are where you crash, and we're probably there. Although I don't know, we might run sideways for 4 months, 5 months, or something before we start the down cycle. But this reversal and this consolidation looks super dangerous. It looks like it's starting now. And on the dollar, when the dollar runs, really strong, it puts downward pressure on the market, and this correlates with the down moves in the market. And the dollar came down a bit, and we had the little bear or the little bullish run for the last 3 months on the dollar coming down. But if you look where it is now, we're right at support on our trend line. The dollar looks like it wants to run strong. So, I mean, this will be a big decision point too. If the dollar continues a down move, that's going to be bullish. If it does another bubble run and goes strong, that'll be bearish. So the dollar is actually a pretty good indicator right now. But when you combine all of the signals, like the VIX is at support where it's super dangerous, the interest rate cycle is on the edge of a cliff that looks super dangerous, the dollar is at support where it could go strong right now. And so if this happens, those should all probably happen right about the same time. And those will be a down move in the stock market, like a crash. And then oil, they announced the OPEC nations announced that they're cutting the oil production by a lot, by like 1 million barrels. And the oil price popped because that's less supply going to come on the market. Although this is not super bullish for oil. The reason that OPEC said they're cutting the oil supply is because of uncertainty in the global economy. It's a pretty generic answer, but pretty much everything that I just said. Like the money is contracting, and so oil demand goes down during recessions. They're just cutting to get ready for the recession. So oil price, I would imagine, just comes down like it normally does during a recession, but when they're cutting supply, that's supposed to hold prices up. So I don't know. The downside target on oil, I don't know. And it usually moves late too. Like in the COVID crash was in like February, and then it was like March, April, May. It was like 3 months later when oil finally bottomed out. So it doesn't exactly follow the stock market or the interest rate cycle like to the month. But in general, oil trends down during a recession, and yeah, the price popped here because they are cutting supply. But cutting supply means they're getting ready for a recession. So yeah, anyway, that's just where we are. That's where we are in the cycle. The metals are all just kind of hanging out on their trends. They have long-term trends that they're just sitting on now that are a little bit volatile, but not too crazy. But yeah, again, like in a recession, silver has a lot of exposure to industry and tends to pull down with the recession a lot, whereas gold during a recession like maybe pulls down at the beginning of a down move, just because margin calls, kind of everything sells off regardless. Just people sell whatever they're holding. But after the initial pull down, gold usually will respond positively. In a down cycle, it's one of the few things that holds up. Just dollars. Dollars get stronger during recessions. And what else do we have? Like Nvidia. If we see the NASDAQ dominance flip over, so I showed you the NASDAQ dominance chart is at is at the bottom of a neckline, and it's back testing the bubble trend that it already broke. And so Nvidia is leading the NASDAQ. NASDAQ is leading the S&P, but like both of those could flip upside down, and NASDAQ and Nvidia can lead a down move here if we go into a down cycle. And you can just see where it is now. Like it's at a super bubbly double top kind of area here, which doesn't look technically bearish. Although this move maybe is a bit overextended right now. But this chart is not super bearish looking. It's just all the other indicators that I showed could mean this gets pretty bearish in a hurry. But yeah, it's not so much that the chart looks bearish. It's just that the downtrend is way down here, and the price is way up here. I mean, price is like 270. The downtrend could be like 50. So, I mean, if we get a big contraction, a big crash, just the amount of room this stock has to come down is a lot. And then, yeah, just back to the interest rate cycle. So we have basically this bear flag. We have a little bear flag on the bank collapse with potential to break down. And then if you go look at banking charts like Ally Bank or something, you can see the same bear flag sitting on the Ally Bank chart. And this is just sitting on a pretty general downtrend. So for this to break down, I mean, it would need to break through a downtrend. But this is kind of where the banking system is sitting, and this looks dangerous. That looks a bit dangerous. And in terms of banks that I think will be most likely to get in trouble for an American bank, like the international banks have more risk than the American banks. Just because dollar loans and liquidity is just much harder outside of America. But in terms of an American bank, like a lot of people over deposit limits, which is risky, and crypto friendly might be risky. People are talking about choke point, like trying to get crypto out of the banking system as a potential thing that might be happening. I don't know, but I'm just looking at the technicals on this and comparing it to the interest rate cycle. So yeah, anyway, that's where we are across a bunch of charts. Please smash the like button for me if you like, and that's just pretty much where we are this week. It's a dangerous looking spot, and the bear market has not started yet. Anyone who says we're in a bear market, no, we aren't. All that crap that happened the last year was on the up cycle. We have not started the down cycle yet. The down cycle is where the bear market and the recession actually happens. So, that's fun.